Welcome to Module 4, Section 3, where I will have a discussion about time.
When we talk about time, there are really two different definitions or two different aspects that we need to talk about. The first one has to do with the context of taking time to learn, develop, and implement a strategy. This involves developing a skill. How much time are you willing to devote to developing the skill of being able to participate successfully in the stock market? There is a maturation process that needs to take place. Going to a 2-hour or 2-day seminar and reading a couple of books does not make you an expert. There are things that happen in the market that take time to learn how to know how to handle. And I say this over and over, even though the stock market or any market for that matter may not be all that complicated, it's just buying and selling. It doesn't mean that it's easy. The way you react to things when you're winning is different than how you react when you're losing. Or you react in a different way when you get into something expecting something to happen and things don't turn out that way. That just comes through time. The time that you need to pay your dues. How much time can you devote to this? Let's say you commit yourself to learning this skill and getting involved in a program such as the program I offer. I have free videos out on the internet all over the place, and I even tell people about them, but they don't watch them. And I'm offering the best information I know how to give. People just say, I don't have the time. Well, you had the time to watch that reality show. You had time to play games for 3 hours. You had time to do other things. It's really a matter of priorities. It's not that you don't have the time. Each one of us has the same 24 hours each day. The question is, do you not have time? It's what are you going to do with the time that you have? Because that is one of the few precious commodities in life that we can't replace. Once it's gone, it's gone. What are you going to do with the next few minutes that you have? So first of all, let's look at a time to learn. The excuse heard most often about investing is that there's a lack of time. I don't have any time to do this. Well, I've tried to really cut down the amount of time by having classes that teach you information that you need to know. I also have videos that I prepare that people can watch each week, and I also have other videos that I prepare each day. I also have blog posts. There are articles. There's a lot of information out there. I like to think that the information I give is the best, or else I wouldn't even be doing this. You don't have to learn from absolute scratch, at least as far as a knowledge level is concerned. Now, you do start from scratch as far as developing a skill. And that's what my program is all about, is to help you develop a skill that you can use to then have success in the stock market. The nice thing about the skills that you'll learn is they can be transferred to other markets. Maybe you trade in bonds in the future, or in futures, or in cryptos, or in Forex. The truth is that people always find time to do what is most important to them. That's really what it's all about. If you have something that you have to do, you'll find time to do it. Aren't you expected to go to your job each day? Can't you just call up and say, sorry, boss, I just didn't have time to come to work? No, you're not going to have that job for very long. That's because it's important to us. And if something is important to you, you will find the time to devote to it. It may mean getting up a little bit earlier, or staying up a little bit later, or sacrificing things, doing things that you would like to be doing, maybe at a barbecue or being with friends. You can't do that one day because you need to study and develop a skill so that you can be more successful in the stock market. There's one saying that I heard a long time ago, and it says, if you'll spend the next 5 to 10 years doing the things that other people won't, you'll be able to do for the rest of your life what other people can't. I'm not saying that from a standpoint of pride. I'm just saying that if you're willing to sacrifice things now, that means that you'll be able to do things in the future while other people are still stuck doing the same old things. And this gives you a sense of freedom. And this lets you explore different parts of your life that maybe you didn't even know were open to you. So then we talk about different time horizons. Different investors will have different time horizons. Some people like to do more short term. Other people like the intermediate term, while a lot of investors are more long-term in their focus. Different strategies are implemented depending on a lot of different factors. This can include your age. Are you 20, 30, 40, 50, 60? Are you married? Are you single? Do you have a large family, a small family? your different financial goals. Why do you want to even be in the stock market? We all want to make money. That's why we have jobs. But why? Have you really sat down and thought about, what would I do if I do reach some of my financial goals? Is there a business I want to start? Do I want to go back to school? Do I want to send my kids to a really good school? Do I want to get out of debt? What things would you do if money was not an object? Do you want to be able to have a nice Christmas or just be able to go on some nice vacations? Everybody's goals are a little bit different. How much risk is willing to be assumed? If you want to take on a lot of risk where you potentially could have a high reward, what happens if that doesn't work out? Or maybe you like taking on less risk where you're building things more slowly over a longer period of time. And I do have a video about risk that I would recommend that you watch. The program that I have is called the SPX Investing Program, and I have different definitions for time. And these may be different based on different people that you learn about or books that you read. To me, the short term is defined as days to weeks. If you're a day trader, short term is minutes. Well, when you're investing in the stock market, these are positions that you hold from anywhere from a number of days to maybe a number of weeks. There are also intermediate term positions that you have that lasts anywhere from weeks to months. And then long term is months to years or even decades. And that can also include even generations. Where do you come out? So when we're talking about defining the actual time horizon, each investor must determine which time horizon is best for you. What works for one person will not work for somebody else. You have to take all the different things in your life and figure out, okay, I have to be a long-term investor. I just have to devote all of my effort and energy into other areas. I can't watch things all that closely. Or maybe you really enjoy this, and so you might come into the intermediate term spectrum. Or you really like doing this, or you're looking at possibly doing this full time, and so you come into the short-term arena and do things that way. So it's common for investors to implement a variety of different strategies based on different time frames. If you are a long-term investor, there are things that you can do in the intermediate term to help protect you or to help generate income. And the same is true with the short term. You might be an intermediate term investor, but you might do things in the short term to generate income or allow for protection. Or if you're a long-term investor and we've been going up for a long time, you may implement different strategies that will go up in value as the value of your portfolio goes down, and it acts like insurance. Those are opportunities that are available to you. This allows for short-term gains to be achieved as well as maintaining a long-term focused portfolio. So you can mix and match. You can put these together in any kind of fashion that you feel comfortable doing. Let's talk about a real dangerous mistake that people make. And I've seen this, I don't know how many times, and it was the catalyst for including this particular slide in this video. One of the biggest mistakes an investor can make, and there are a lot of them, but this is one big mistake. You think that the way things are right now is the way that things are always going to be. The financial media is very guilty of this. It's like they're bipolar. If we're having an up day, it's like party time. If we're having a down time, it's like a funeral. And this can change from day to day. When you're looking at the market and we're having a really big up day or down day, and you make a decision based on that, that's wrong. You don't have the proper context at that point. Some of the biggest up days you'll ever see are when we're in a bear market or things are really going down. Some of the biggest down days we'll see, like the COVID plunge, that came in the midst of a bull market when things were going up. So just reacting to what you see happening right now is not necessarily indicative of the way things will be tomorrow or next week or next month. So don't get hung up on what's happening at any given moment. Try to maintain a big picture focus at all times. In other words, you're making long-term decisions based on short-term conditions. And I understand that the financial media has to do this. They need to entice you to watch them. If there are problems going on and they can scare you with some kind of headlines to keep you watching longer and watch their advertising, then that's what they're trying to do. They're not necessarily giving you actionable information, but they just want to keep you drawn in. But I've seen this over and over with a lot of different students where the market is really up and so they get in. Well, at that time, we were in the midst of an overall downtrend. And then they wonder why they lost very quickly. It's best to develop a plan when the market is not open. So this is something that you look at in the evenings or on the weekends when you're not under the gun of having to make a decision. You develop this plan when you're in a comfortable situation, and then you have something that you can use that when you're really in the heat of battle, you can then implement that plan. So once you develop that plan, stick to it no matter what is happening at any given moment. I will guarantee you this. If you invest or trade based on emotions, you will lose. You'll be right just enough to justify what you're doing. But in the overall scheme of things, you will lose, you'll get frustrated, and you'll quit. You must develop a plan and then follow that plan and then block out what else is going on. We see that in sports. We see that in business. We see that in relationships. We see that in movies all the time where it looks like everything's going to fall apart. And then right at the end, something happens and turns it all around and everybody lives happily ever after. Well, it doesn't always work out that way in the market, but it works out that way enough so that the plan that you've developed, that you've taken time to develop, and that you've tested not only using historical information, but you've forward tested it as well, you know that it stands up. It's not always going to be right, but you know that you can rely on this, and so stick to that plan no matter what you see happening. Why do you think airplanes have backup systems? Even without those backup systems, it's still statistically a very safe way to travel. But if something goes wrong at 34,000 feet, one system breaks down, there's another system that's supposed to come in and take over and make sure that everything's fine, and you in the back as a passenger didn't even realize what was happening. Then the old Boy Scout motto, be prepared. When implementing a plan, there are only 3 things that the S&P 500 or any investment can do. It can go up from the place that you bought it. So you buy it and then it goes up from there. Or you buy it and it goes down. Or it can go sideways. Those are the only 3 things that can happen. And there's a 33% chance of any one of these things happening. So if you buy something hoping that it will go up, that's a 33% chance. That means 66% of what can happen is against you. What are you going to do about that? Are you doing things now? There are things that you can implement to take care of that other 66%. Now, it may bite into some of your returns, but when you're wrong, at least some of your insurance measures or hedging measures kick in and don't make the loss as severe. A successful investor must be prepared for all 3 at the same time. I'm not a doom and gloomer, and I'm not an eternal optimist. I like to consider myself a realist. Good things happen, bad things happen. It's part of the world that we live in, and so we need to be prepared. What are you going to do when you get into an investment and you're right? You're just going to ride it out hoping that everything's wonderful? Did you even plan for that? Do you have a profit target or a time target or some kind of a benchmark that you're going to use to say, okay, I fulfilled the objectives that I had for this investment, so now it's time to get out? Then what are you going to do if you're wrong? You get into an investment and it goes against you. How much are you willing to risk before you just say, okay, time to cut my losses? We get that figure of speech from the stock market and then go on to the next one. Or one that can be very frustrating is you get into an investment and it does next to nothing. It just chops around. You were expecting a big move up or a big move down and that didn't happen. What are you going to do? What's your plan in case that does happen? So the program that I teach, called the SPX Investing Program, will help you to see all of these different scenarios at the same time. I constantly have this in my mind. When I do the daily and weekly videos, I'm saying, okay, what factors are we looking at that suggest the market's going to go up? And then what factors are we looking at that could suggest the market is going to go down? And what things are we looking at to maybe think that it's going to stay the same? We look at all of those at the same time, and when we write down our plan, we plan for all 3 of these before we even get into the market.
This concludes Module 4, Section 3. And I will pick up with things again in Section 4.